live with Trends with Friends, and we have a very special guest, podcast Gen Z expert. I don't know, are you a Gen Z? Michael Batnick, say hello to the Trends with Friends team.
Dude, hello, Trends with Friends. I'm pushing 40. I'm a millennial.
You're a millennial, so we've got a lot of, we got a boomer. Michael Parekh, are you a boomer?
Boomer.
I'm a boomer, worst generation ever. I think I heard Mark Cuban say, worst generation ever. We went from sex, drugs, and rock and roll to Fox News, like super quick. He was on Jon Stewart last night. It was pretty funny. You were on Trends with Friends. We're doing it live. Really appreciate. Tell your friends if they're on Twitter right now to come over and watch us. This is probably one of the better roundtables you're ever going to find to do a live, markets podcast. And we have, self-proclaimed worst investor of all time, Michael Batnick. He makes fun of himself. He is so much. He was.
I'm
asking,
long Starbucks, not to brag.
Dude, Starbucks is happening today. Congrats.
So what's going on with Starbucks today?
Cappuccino. There's a new. You pick your protein, put it in a Starbucks swap CEOs, not swap, but they took the Chipotle's CEO,
and you get chips and guac.
You get tips and guac. They have a guacachino where you can just put some cold guacamole in a latte, so that your coffee tastes like a piece of shit. So Michael, welcome. You're in New York. JC, you're back at home. You were just on Batnick's show. Phil Pearlman in the basement doing time, hiding out from his family. I really feel like it was nice that you didn't wear a child's medium shirt to flex for Michael Batnick today. Usually he squeezes himself into a shirt, Michael, but I think he's and then I don't know if you've met Michael Parekh,
my friends, Jade Bistro, my friends down the street have a great Chinese restaurant. If you're ever in Suffolk, New York,
nobody's ever there.
Go have dinner there.
Yeah, Michael, have you met Michael Parekh, the legend?
I have not, but I'm excited to.
We've just said hello. I look forward.
So Michael was Goldman in the heydays of the 90s, running internet research, and he's our expert on all things tech, which we like talking about. We like talking about charts, the markets, what's going on, trends with friends. But Mike adds some actual gravitas and fact checks us every day, and so he's like us having an AI bot, but with this
without the hallucination. Without
the hallucination. Depends what we've eaten that day, but the silky smooth hallucinations of Michael Parekh. All right, Phil, who's going to lead the show and include Mike. Last week, obviously, we talked about the VIX. We did it live. We thought it was a weird signal because the markets, weren't really correcting per se. Stocks were a little bit correcting. And then JC, you went on Michael's show, the great show Compound, and you and Josh Brown called it the dumbest thing ever. And here we are a week later, VIX under 20. Donald Trump is back on Twitter. I think that makes sense. The VIX being back under 20 makes sense. Inflation, obviously, Michael Batnick, I think you've always known this, but inflation is caused by oil. And Michael, you've obviously known this because Goldman invented that saying. That's where Trump picked it up. And then we also know that Starbucks, which is kind of breaking news, not so much that we're Starbucks experts, but Starbucks got the CEO of Chipotle. So Phil, where do you want to start today? Go ahead, take it away.
Well, let's just talk about Starbucks. So really, the stock's up like 25% today. We have a chart, a JC chart. Maybe we just begin there. Like, JC, what's your view here? Is this a top, not a top?
Batnick, this is I love that Batnick is here. Batnick, this is one of those great things where, when a top is not actually a top. My favorite Head and Shoulders top is when it's not what everybody thinks it is. And when you in kind of your second week of technical analysis kindergarten, you learn about this particular pattern that tends to be reversal in nature. But here's the key thing. The thing that they don't tell you in kindergarten that you have to learn in real life is that asset prices trend. They don't just reverse. Like, that actually is more rare. Asset prices trend. So many times, stupid humans think that there's this particular pattern that has to work out that way, even though we have the data that suggests that it's most likely just a consolidation and will continue in the direction of the underlying trend. So oftentimes you see these topping formations, double tops, head and shoulders top, all these things that are really just a healthy consolidation that resolve in the direction of the underlying trend. We see it time and time again. We saw it 3M recently. Here you're seeing it in Starbucks, just classic. Michael, I mean, come on, man.
JC, I see what you see. When I bought Starbucks after the debacle of a quarter, when the CEO was getting lit up by Jim Cramer, those are usually good times to buy. I am a lifelong Starbucks drinker. Go there fuck off. I go there 7 days a week. I drink the coffee. And unlike a company, so I respect global consumer brands that are best in class. And unlike, say, a Nike, what are you shaking your head at?
What's the best in social class of dummies lining up for $7 coffee? That's not.
I don't know why I asked you. All right. Unlike Nike,
I chimed in, so I apologize.
Which is a great global brand, Nike is getting the shit kicked out of it by its competitors. Yes. Starbucks had a self-inflicted wound. There's no competition, but what they did was they rode the inflation wave just a little bit too far. And that is a problem. That is a mess that they can remedy. I didn't expect it to happen to turn around so quickly. Now that the company turned around, the stock did, obviously, with the CEO of Chipotle coming in to right the ship. But to JC's point, I'm almost done, Howard. To JC's point, I saw the risk reward there at previous support, and I said, you know what? I thought it was going to take a few quarters, but I would rather be early than late. And there you go. Sometimes you get lucky.
Look at the long-term chart. So Howard can tell us again how this is not an industry leader. Can you throw that at the longer term? Come on, tell me what have they been doing so wrong, Howard?
Dude, I'm just fucking around. What I would say is what Michael got wrong, because that's his middle name, got wrong, is the Nike is very self-inflicted wound too, right? Like they ONN exists because Nike got ballsy during COVID with distribution and
they fucked around.
Yeah,
do you wear Howard? Do you wear ONN? Do you wear those?
No, they're not cool. They're not actually good. I hate the bottom. I hate the look. They're very narrow.
I got them for tennis. I got the tennis shoes.
They're not an actual great shoe for working.
They're not a great shoe for actually running.
Anyways,
just from a
it's not for running. It's for tennis. Is it Federer?
I explore shoes, right? I have now have enough money to buy overpriced shoes at Kith, which are generally just old man New Balance that you can only buy at Kith and overpay for. I still like Nike golf shoes, like the Jordans. They make a golf shoe that you can wear all day too. So it's like versatile Nike. I'm still Nike. I'm not loyal to any shoe brand. I'm definitely not loyal to coffee because I'm not a coffee connoisseur. But I think Michael's right. If I were to go through all my friends and my sisters who are Starbucks, and Ryan Spoon, shout out to Ryan who runs Yahoo Sports, who are there 2-3 times a day. I get it. It's a habit. It's a poorly run Philip Morris, but with less lawsuits. So I think Starbucks is going to continue to be a winner. What I'd love Starbucks to have is a better food selection, just something edible. And then the other thing about Starbucks that I see is this $80 trillion that young people, I call it the degenerate economy, are going to spend on are they going to make it to that group? Batnick, do you see that group adopting Starbucks? That would be the question, because they're going to be loyal to their brands, and that's going to be a big transition of spending power here.
Caffeine's addictive. I don't cover the consumer, the space, but I don't know who competes with Starbucks.
Dunkin'.
Everybody.
Dunkin' and then the boutique ones. I agree with Howard. I don't like Starbucks either. We're a Dunkin'
and Dutch Bros and whatever. So the chart, here's the thing. We'll move off from it. Interesting news. There'll probably be some lawsuits. The chart looks like it bounced where it needed to be. Michael Batnick is saved for another day to continue to put poor decisions to work. We look forward to his next poor stock market idea. And by the way, Batnick, as a fan of Compound, people should know that you and I go way back. Obviously, JC was just on your show. No one could be happier. They don't care about you, but I always say, the fuck? Guys are just knocking it out of the park and setting an example for young investors everywhere by just showing up and doing good work and making investing fun. Proud of you always, you and Josh.
Thank you,
I
Howard.
think I've been on your show a few times. I'm not looking for another visit. I just wanted to say, thanks for coming on. And JC had 5 visits, and that was a cool sweatshirt you got him, the Miami sweatshirt.
How sick is that? I can't wait for it to be a little cooler. I'll rock that.
Yep. Anyways, all right, Phil, move on. Michael, sorry, go ahead.
Just one thing, or 2 things on Starbucks. Number one, I think you nailed it, habits. This is one of the most appreciated habits company in America. Whether it's coffee visits per day, etc. Number 2, they have been one of the leading companies on the technology front. If we forget, before Apple Pay, it was really Starbucks cards and etc. They have billions in float on those cards. I just point that out because where we're going with online payments, etc., one of the opportunities is to rejuvenate that. That has stagnated for the last couple of years. Third, most important, fundamentally for most companies, it's management, right? I mean, Brian Niccol. I mean, there's a reason this thing's up 25% and Chipotle's down 10%. 50-60 billion on Chipotle and 100+ billion on this one. Is that Brian knows how to do these executions at scale. It reflects in Chipotle's 800% appreciation. So there's a lot of upside. Last thing I'll say, for a lot of the 1.4 billion Indians who keep lists of Indian American CEOs of companies, this one is a loss. We lost an Indian American CEO, but I think as a longtime Starbucks shareholder and consumer for a long time, I'm rooting for the new guy here.
Michael, is there an Indian CEO ETF?
There should be. That's a great idea. Let's call BlackRock. Add it to their Bitcoin.
How many S&P 500 companies have an Indian CEO?
Last I checked, in technology, it was approaching 25 to 30%. It was a pretty crazy number.
Not oil and gas. Not a lot of.
And I don't know about oil and gas. That's a good question. But
anyway, would Kamala count as an Indian CEO? Because Trump says she's black. She just zigzagged into black.
She just overnight.
I'm just trying to make Michael laugh. Listen, I'm out of this show. I'm just trying to make Mike laugh.
No, she just turned black and no one noticed.
She just turned black. All right, so
lost another Indian, Michael.
Yeah, lost another Indian, Mike.
So one of those interesting charts in the world.
What's the trend? I need a chart.
We're losing Indians. Trust me, you got plenty of Indians, Michael. You'll be fine. I don't know if you heard. They got a lot of them over there.
It's a divergence.
Yeah, they have a couple.
Phil, what's next?
So most interesting chart in the world. Ari Wald posted a chart about the difference. Like, how do you know when a bull market's over? How do you know when it's a correction? How do you know when it's just a pullback? What's the difference? And so Ari Wald from Oppenheimer, head of technical analysis at Oppenheimer, old friend of ours and good friend of JC's, posted this chart the other day, and I just wanted JC's take on it. I think it's one of the most interesting charts in the world. We're near-term oversold, but we're still within a long-term uptrend. So you want to give us like a little synopsis of what this chart is saying here?
Yeah, I mean, it's the percentage of stocks in the Russell 3000. So the Russell 3000 represents approximately 98% of all investable assets in the U.S. equities market, right? That's what the Russell 3000 is known for. So what this is suggesting is that the majority of the stocks that compose the Russell 3000, 98% of stocks, are in longer-term uptrends. They're above their 200-day moving average. But a large percentage are also below their 20-day moving average, which is basically like a month's time, is about 20 days. So short-term oversold conditions within longer-term uptrends is basically what the quantitative data would suggest, that we're in a longer-term uptrend. There's no evidence that we're not in a longer-term uptrend, right? So that's not surprising. The explosive nature of the short-term downtrends within the context of a volatility spike make perfect sense. So this is just a way to quantify the things that we're seeing. Ari does a great job of that.
And
go ahead. Sorry, Phil.
Go ahead.
I think what this pulls together, Michael, we're used to you as interrupting each other. I think what this pulls together is what we talked about last week. When we talked about it, the VIX didn't make sense to us. Like, you got to buy VIX 60 because that's what, I wait for spikes in VIX. But as I was buying it, it didn't make sense to me because like you talked about on Josh and Batnick show after on the compound is like, man, weren't stocks supposed to be whipsawing all day when the VIX is 60? You're up 8%, you're down 4%. Like, I just, it was like a trend day off the bottom.
Yep.
Right. And so I panicked out a little bit. It didn't seem like, you prepare for a trade, which we talked about live for the VIX. And sometimes, even if you do everything right, you have to call an audible because you get the heebie-jeebies about something. And that VIX 61 was a heebie-jeebies, not because the market scared me, because the VIX really did something I just didn't understand. So I called an audible. I've been selling into whatever I bought. I've been selling the last few days. And, I'm long anyways. I'm a long-only guy. But, like, I was thinking I'd be able to put money together to work for the next 6 months, and it ended up a lot of it being 6 hours. So you call an audible. I thought that's interesting. But this chart from Ari Wald, and I think JC a couple weeks ago before the VIX spikes, we shared a sentiment. I don't know if we could pull that back up, but we were all over this saying we didn't know when it was going to happen, but JC shared it on the compound too, but we could pull it. JC shared a sentiment, cross sentiment index, and people were just sloppy. It was stocks were going up. Anybody who's watched the market for a while, and I was on Twitter and StockTwit saying I'm just taking some profits, not because I had any ink. It was just weird. It was just a weird up every day, up, good metrics, good breadth. There was no necessary reason to sell, but when you looked at the breadth of sentiment, it was super sloppy. And maybe that led to the VIX 61. There's all kinds of things, but we're now at VIX 20. And I'll tell you what, Phil, what's so interesting to me is the news really feels like a VIX 20 market, right? The election went from a sure thing to Trump to who knows. There's just a lot, Iran. You think if there was going to be a VIX 60 thing, it would be based on Iran threatening Israel. So VIX at some level seems a little bit low for all the chaos. So it feels like that week was just a dumb week.
Israel's one of the best performing countries this month.
Now, that is the most interesting chart in the world to me, Phil. So if we could pull that up, here's a country, planes are not flying into Israel right now, right? LL is about it. Lufthansa stopped flying planes. The economy is basically shut down. Now, granted, in a digital economy, do we need flights? Yes, but do we need them like we want? But this is the ultimate chart, even though it's a small market of people don't know what they're doing. Because if you ask 99% of people, including the Hamas protesters, they would say they've destroyed the stock market of Israel and say Ali Akbar. But it's a reverse Ali Akbar of the stock market. I call this the reverse Ali Akbar cup and handle. Michael, you can steal that if you want for your show. What are we seeing here, JC?
I mean, this is just the Tel Aviv 125 index. So this is like their S&P 500. It's a lot of technology, 40% technology, as you can imagine. So it's heavy tech. But when you go country by country, you'd be a little bit surprised to see that the best performing countries for the month of August are Israel, Brazil, Egypt, Indonesia. These are the best performing countries this month. It's just, I would not have expected that is all. And when certain things happen in the market that catch me off guard, that I would not have expected, that stands out even more so. And just rattling off those countries as the best performers this month, probably not a lot of people had that on their bingo card.
Yeah,
there's a disconnect. There's a disconnect between what actually happens in the market and what everybody's paying attention to and noise. And whenever there's war, whenever there's instability, international instability, or even instability within the country, everybody's always pointing fingers at that and using that to blame what might be occurring in the market or what fear of what could happen. And meanwhile, it really doesn't make that big a deal. This is a perfect example. So all of the saber rattling with Iran doesn't really matter. I mean, the S&P's up 10, 11% this year. The Israeli Tel Aviv market is up 9, 10% this year. For all of the, I'm not familiar if there's an Iran market or not. It's probably just doing what it's doing too, if there is one. And so
we don't do business with Iran.
No, in that market, every day the worst performing stock, they hang the CEO. It's just an old. I don't know if that's folklore, but that would do well. But that YouTube channel of the Iran stock market would do very well if they did that.
Wait, let me just rewind for a second. It's not that the things happening in Israel don't matter, or the war. I mean, understand that there's always a lot of these things happening. It's that the market is factoring in a lot of other things that are happening around the world that are just not getting the same attention. So it's a dispersion between what's important and being factored in versus what is being advertised for completely other reasons, right? The media is not incentivized to tell you what's happening in the world. They're only incentivized to get you to consume their content, period. These are two different things that I think a lot of consumers fail to remind themselves of. So if you're out there listening, remember, it's not that it doesn't matter. It's that there's so many things that also matter. They just aren't getting as many attention because the attention is cap heavy versus equally weighted.
A question for Mike. So you manage almost $5 billion. So, and you're head of research. So what was it like? You're not trading because you're head of research. So what's it like dealing with? What's the percentage? What's it like? Phones and people. I know you're always sharing and contributing, so these moments shouldn't mean as much, but what does a $5 billion firm communicate to its clients, and what are the clients asking at VIX 61? Are the phones ringing more? So just tell us a little bit about the
I couldn't tell you because, as you mentioned, Howard, I'm not an advisor. However, what I can tell you is that if the phones were ringing, I would know about it. Like if it was abnormally, if there was a lot of worry, I would know about it. So we communicate with our clients. We put out some notes. But as you mentioned earlier, it was over before it started. We gapped down, they bought it, kept going up. And so I think what happened was it was a confluence of events that led to a quick mini VIX panic. It was a perfect storm. And the perfect storm included softening data, the job market slowing down. The Fed had decided to hold a few days before that. And everyone was like, oh shit, they missed their window. It was, as JC mentioned, it was just complacency. Everybody was off sides for good reason, right? The economy's been okay. Everybody's been bullish. It was Buffett dumping half of his Apple position, which would have rattled the markets anyhow. And then it was the yen carry trade unwind. And so all four of those things happened in a 72-hour window, and you got some things breaking at the open on Monday. But I think because it was over so quickly, from my perch, it was more or less business as usual.
So Pearlman, how hilarious! Nice job. I think you're spot on with Pearlman. How hilarious is it that people think it's bearish that Warren Buffett only has $100 billion worth of Apple?
It's only 30% of his portfolio.
He must be real bearish.
Michael, to you, because Michael's
just
our
hilarious how reactive people are right now, and I think over a longer period, or especially right now, that's a bullish thing in general because people are so reactive. Anytime something bad happens, people react, people sell, people overreact. And then you get like these mini capitulations in 4 days instead of having this elongated 20% down bear market.
Let's flip to Apple quickly. It's probably not on your screen, but Michael's here and we talk about Apple so much, and Apple and Google are his favorite ideas of the Mag 7. So with Apple, I shared a chart yesterday of their gross profit like now at record highs, right? And maybe that's why. So they've moved to a post iPhone era, whether you like to, everybody wants to believe iPhone sales are down, Apple's a different, they can't find their growth number. Well, their growth number is just cash. And their growth number is in gross profit because they're a service business. This goes to what you've been saying for a while, Mike. So just walk us through and catch us up on that. And Warren Buffett as well, your thoughts on, right, he still owns $300 billion worth of, or whatever it is, worth of Apple. I find it quickly more bullish that he found people that are willing to own it and the stock's basically at the same price. That's a bullish sign to me. So just give us some Apple thoughts.
At a high level, Apple, and as you mentioned, Google, and I've also added NVIDIA. These are not stock recommendations, but just in terms of the frameworks I look at, in terms of AI, how it's going to secularly grow over the next 3 to 5 years, those three names have huge legs. And Apple is, and I've been on record on this, is one of the most underappreciated names out there primarily because they have the distribution. They have a unique distribution to over 2.5 billion people who use their devices every single day, multiple times a day. We were talking about coffee habits and other things earlier. And this is a company that is far from being behind on AI. They are the services revenue that, Howard, you pointed out rightly so earlier today on Twitter, it's 20 in this last quarter, 24 billion out of 85 billion in revenues. Yes, there is a little bit of turbulence potentially because of the Google antitrust search distribution litigation that's going on. I've written extensively about it in a remedies post. But I think Apple and Google will be able to navigate through that. The services piece is one of the single biggest beneficiaries of what Apple calls Apple Intelligence over the next 2 to 3 years. They'll be able to add a lot more services. There are already talks about them potentially charging a subscription fee for a higher end Apple Intelligence subscription, as an example, out of 2.5 billion. So, and the distribution piece for AI services to the consumer is the big missing link for the OpenAIs and the Microsofts of the world. They do not directly yet touch billions of users in terms of their daily habits. The only other company that does is Google, which is one of the reasons I talk about it, and Meta, primarily through their 3 services. So Apple, yes, the hardware is their distribution mechanism, and one that most of the world that uses smartphones, and it's an aspirational brand, much like the Nike shoes and the shoes you were talking about, Howard. It's an aspirational brand the world over, and they are absolutely leaning into what I call small AI with a huge focus on privacy and trust, using consumers' data privately on those devices and providing them incremental services. And they've done a great job to date, grown it to 24 billion or so per quarter, and they have a lot of upside potentially as the AI cycle accelerates. And by the way, a little cherry on the cake is that Apple also should see a heightened upgrade cycle on the devices, because increasingly now, every year, you're going to get better AI processors, neural processors, better memory, etc. And those are the critical things people are really going to need to make AI helpful to them, whether it's in your
Phil just wants to stick it on his face, right, Phil? Just
no.
Like
here's what I want. I want to not think that it's AI, to not
Correct.
know anything about AI at all, to not care what the chip is, to just turn on my phone and have it know that, I want Chinese, or I have a meeting at 3:00, or whatever it is I want, and already know it and just take care of it for me or guide me to where I need to go. That's where I want to get, where I don't have to think about it all, and it's not even AI. It's just an awesome phone.
And Apple is the best position to deliver that in 2 ways, Phil. Number one, most people who have been using for the last few years these phones, they don't think about machine learning and deep learning, yet almost every app you use on here has been providing that for a long time. Uber couldn't have become Uber without it pioneering their iOS app that uses machine learning. Number two, what you're describing is also very critical, because Apple has the biggest roster, millions of developers who build the apps. And and I talked about it in the note after their WWDC this June. They opened up all kinds of APIs, application programming interfaces, to their upcoming AI services, to the millions of developers who have the apps. That's $100 billion plus market. And AI services through those developers are going to be coming through this without you thinking about AI. Everything from fitness to what you eat, etc. One of the most exciting AI papers I read this week, because Phil, I know you're focused on fitness, rightfully so, is that increasingly the AI is being used for things like, as you're eating food with a spoon or on a plate, it just computes for you how many calories you're consuming, what kind of quality calories, and it automatically logs it for you. Today, less than 5% of people use these apps for health. Basically, what you're describing is about to happen over the next 3, 4, 5 years. 50% or more people are going to eat better because their devices will tell them that they're doing so, or what they could do to correct it.
I think health, sports, fitness, finance, that's where all the vertical. Web 2 is all about if Twitter could do it all again, they should have verticalized like Yahoo sports and fitness. I think the big story here on Apple this week, and we can chime in because everybody has Patreon pages here, is how aggressive Apple's being in an era where, why are they being so aggressive? So yesterday, Patreon, which is a creator's platform, let's call it. It's one step below OnlyFans in that I don't think there's porn and Nazi stuff going on, but comics, etc. So Apple's enforcing this 30% tax on like a multi-billion-dollar startup, much like they did to Epic. So, Mike, why are they doing this? And does that bother you in an era where like it just seems like they're just pushing the buttons for no reason?
It's a very binary issue. It totally depends on the frame. If you use the frame that they're charging an Apple tax of 30%, yes, it can get very contentious, especially on the regulatory front. But you flip it, yes, and there's no question they're pushing at the edge, just like every big tech company, on eking out every penny for their shareholders across everything. Google, there's more ad links than ever. Amazon's more sponsored things for e-commerce, third-party sellers, you name it. Meta basically is the master of using AI and other technology to ramp up their advertising for providing the actual services. So every company is guilty of what you're describing, which is pressing hard on the monetization front. Flip it on the 30% piece is that Apple is going to provide a lot of ability for people to create new services, new things that we haven't thought about through these AI infrastructure pieces, Apple Intelligence that I'm talking about, that will be worth the 30% for increasing number of developers. And it's not yet evident. It's just that we're looking at the 30% today at the end of a 15-year smartphone cycle where the innovation has gone from being a growth thing every year over year to a much more linear growth curve. And now people are like, what's next on my apps? What's next is coming. And Apple does need, and all the other tech companies do need to continue to focus on making sure that they convey the value they're providing for the tolls they're taking, the 30%, et cetera. And that's a place where I think there's a lot of room for improvement for the CEOs of all of these companies, especially Apple.
All right.
But the
Phil,
last thing I'll just say is that the biggest issue people have with AI is trust and privacy. And Apple has done a good branding job from Tim Cook's point of view of conveying that they're the safest one to do that with privacy, respect for the user data. And if they can communicate that with AI over the next 3 or 4 years, they will increasingly earn the 30% from their users and from the developers.
Just last quick comment here on this. So I am a fitness guy. I don't wear a watch. I don't have an Aura ring or anything like that. But I'm getting so close to getting one because of you, Michael, because you talking about, like, if I get to this point where I could just put a watch on or put something on and I never have to worry about my VO2 max and I never have to worry about my number of steps, because I never want to think about that stuff, because I want it to be about how I feel, not about what some machine is telling me how I feel. But if I could put something on and it just tells me when I need to do something, like, hey, you know what? You need to go to the doctor because you went for a run and your heart rate was especially high. And then I go to the doctor and the doctor's like, yeah, you got something going on. That's all I'm going to want it for. And when we get to that point, and I know we're getting close, and I know you've told me about that's where I become a buyer.
Get the whoop. Get the whoop.
Exactly.
Roman.
The whoop
I'm
that
not interested
JC's
in any
talking
of
about.
it yet.
No, but I'm just saying.
I hear you.
But even before Apple, I mean, people may remember Fitbit made the 10,000 steps popular. These are habits.
Yeah.
The habit piece is the key. Without thinking, the Fitbit 10,000 steps was basically a thing to mentally lock you in the era of cognitive misers, where people just need a heuristic. 10,000 steps was a heuristic. Apple's done the same thing with the watch, which is the biggest wearable category on the planet. This would be a S&P 100 company by itself in terms of the revenues. It's over a third of the smartphone market, and the 3 rings for exercise, movement, standing. it is used by probably a third to half of Apple Watch users on a regular daily basis, and it is changing behavior, and for the better. The kinds of things you're talking about, where you're changing your habits because you're glancing and you say, "Oh, I have not stood up." This thing will tell me in 20 minutes that, hey, it's time to stand up. That's AI. and it's helping me live a better life before I get sick. And that's one of the key opportunities.
Michael, Michael, what do you see in AI? Michael and I share deals all the time. So for people listening in, I don't manage $5 billion. You know who does? Ritholtz Wealth. I think the wealth management business is a very exciting space. We're an investor in Koifin. Michael knows all this. He's an investor in QuarterWrap, which now Stocktwits is a partner with. We share deal flow, Michael and I. And it's a tough industry, the wealth management business, because human habits are built in for 100 years here, and there's always been bad software in wealth management. So, Michael, walk us through do you guys talk about AI and how it can help your customers?
Oh, yeah. I think the thing that I am most excited about in terms of AI and how it intersects with the wealth management industry is not investment management at all. That doesn't excite me. I think that's going to be commoditized in 2 seconds. I don't think these AI companies are going to be able to compete with the Renaissances of the world, which have been doing this forever and ever. But what gets me excited about is how can we leverage this computer technology to make the advisor's life better? And I'll give you an example. The young paraplanner role is a very difficult role for a few reasons. Number one, typically these are young people who need training, who need guidance, who need mentorship, who need a career path, who need nurturing, who eventually need to graduate out of that role. And so let's say that an advisor spends 3 years mentoring, training this person, only to have them leave the nest. And then the advisor who spent all of that time has to find somebody else and start from zero. It's horrendous. It's just a bad role. So if artificial intelligence can come in and eliminate that role and help the advisor prepare for a meeting, prepare for a follow-up, do all of the things that are effectively grunt work, that is going to change the advisor's day-to-day job. And there are companies that we've invested in. There are companies that are trying to build this. I don't know if it's in 12 months or 24 months or whenever it is, but I have zero doubt that this is going to be a thing that is implemented across the industry sooner than later.
So what are the kind of things that they're going to be able to come in and what are the kind of grunt work things that they're going to be able to get rid of?
So I'll give you an example. You have a call with somebody. You have to log this in Salesforce, right? If you're serving 75 households, I don't remember the last conversation I had with this family, 7 months ago, 3 months ago, whatever it was. That's one example. Also, just meeting prep. So post, pre, all of that sort of thing, all of the data, all of everything that you're like, ugh. And that's really hours and hours and hours a week. That's going to be done by a computer.
Even for us, we have meetings and there's like a Zoom AI taking notes that sends it to us afterwards. And like it alerts me that the AI is like following along. Like, how great is that?
Another example, there will be programs that have follow-up emails after your phone call that are done by a computer that you will say, boom, boom, here's what we covered. Yep. Okay, good to go. Hit send.
That's already happening. Everything from Outlook to Superhuman. There's a bunch of companies in that space. Michael, you're totally right.
And so, what companies is that bullish for? Is that bullish Salesforce, bullish Microsoft, etc.?
It's bullish for businesses that have good businesses of their own data sets, which we're going to get into with what the leader, the exchanges that we get into the end.
Yeah.
It's bullish. What's stupid is, and sorry to interrupt, is what I've tried to mentor Michael and their crew as they make investments in startups, and they entered the business in an era where it was just stupid. It was nobody's fault other than the free money. And we're seeing that stupidity play out in AI. Knowing what we know today, what JC just said about Zoom and Google Meet's just launching an AI note taker, there's probably $10 to $50 million fundings in note-taking AI products. So we could talk about I know on their show, they talked about the bear market. There's still a bear market going on in venture capital, right?
Yeah.
Like people talked about the short bear market. There's been 2 bear markets. I heard you guys talk about that on Compound. You know where there's a bear market for the last 2 years? Venture capital. You know where, if you look back to 2018, classes, Michael Batnick, because you entered VC space, and Michael Parekh, you probably agree with me. When we look back at venture capital outside maybe crypto and a few, maybe a couple AI funds, you were going to see some of the worst returns over 10-year periods. We're not talking about an 8-month bear market. We are talking about the bear market that everybody used to see in the stock market has moved into the venture market because of the crowding. So I think, and hearing a lot of, I'm listening to more and more podcasts from friends who are doing podcasts who are smart people, and that's why we started this show. I start melding together this story because all I hear about stock people saying is, wow, that was a short bear market. Well, it's a short bear market because venture capitalists continue to do stupid things because they don't even understand the moats that Facebook, that we talk about here with Michael, that Apple, Facebook, Google have, because they control the pipes. So, we're missing the bear market. Michael's missing the bear market. Michael's investors are missing the bear market unless they're exposed to late stage venture capital.
Let me ask you this,
Howard.
Howard.
In one of its most epic bear markets, kind of like they're in their 2000 to 2005 moment.
And if there were a VIX,
moment.
To Howard, your point, if there were a VIX to track the private side on that, what would you say the VIX is right now on that?
It would be at STUPID, meaning it won't go down until people stop being stupid. And so it's a really hidden bear market that I'm watching every day because I talk to founders who can't raise money for good ideas that are actually 6 years ago would have been easily raised a Series A, but because no one wants to look at it because they're dealing with headaches from bad investments they made 6 years ago. The reason the public market is still the most interesting, fun market at times, and people got sidetracked with VC investing, is that you can at least change your mind. Okay, there is not enough weight put on the fact that you can talk about Starbucks and change your mind. You can't talk about your note-taking AI app and then see Google do it, and you've got $10 million in the bank at your crappy AI product that just became a commodity. And so I think what's really hidden in that VIX is the pain that's still not even surfacing in these thousands of kids that raise $1 to $100 million.
Well, hold on.
That are walking out of business. They're literally walking around out of business looking for jobs.
If this is so bad in the venture capital space, right?
It's not so bad.
But then Batnick, how can we be late in a cycle, in a bull market cycle for equities and risk assets in general, if it's still so shitty in VC? VC's got to get better, I feel like, before the end of a major cycle, no?
I feel like there's a gigantic disconnect, and Howard's been doing this longer than I have, but I don't see what one has to do with the other. I know that might sound dumb. Wait, how does private equity and public equity not? It got so disconnected that the rolling bear market, and I had a company that's, I wouldn't say they're firing on all cylinders, but they're doing pretty damn well. They just did a down round, and they're doing well. And if it's 2 years ago, they would have done a stupid up round. So I think the disconnect, especially in growth equity, whatever, you're right. The disconnect in growth equity got so bad. And I think a lot of people are completely, if you're not invested there, how would you know how bad it is? But it's bad.
That's interesting.
Friends with friends, so I diverge. You got to understand, when I started doing this, I would go on podcasts or whatever shows where I would, on my blog, talk about how connected the markets were. So there was a period when AngelList started where it was a euphoric new signal of connection, meaning you could go on AngelList and see 50 CRMs. You could go on AngelList and see, oh my God, there's 50 CRMs being funded. So there was signal there saying, okay, people are coming for Salesforce. Now you could say that's stupid or smart, but at least there was signal. So the markets had not been connected yet. And with the beginning of AngelList, which I used to write about in 2011, it was a euphoric moment for idiots like me because I had a data set that connected private markets to public markets. What happened by 2021, everybody was looking at the data set, which can be good or bad, as we all know from looking at charts, but they were looking at it in the completely wrong way. They thought they had signal that they didn't have. And people were flocking to sectors that weren't ready to be disrupted or didn't need to be disrupted. And so now you have this massive bear market. No one asks these questions because no one gets paid to tell you the truth. There's no real profits in telling the truth. Go look at New York Times numbers. They've learned this. We should talk about that. They're doing better than ever by not telling the truth. And so what happened in VC land, everybody just made up their own truth. Their new truth in VC land is only Trump can save Bitcoin and Silicon Valley. This is like complete anti-ethical behavior by venture capitalists. They're just supposed to be, may the best company win. Now they all of a sudden need a president to align with them so that they can have an advantage. Like the venture market is so fucked up. And again, I hope I'm wrong because I don't care. It's my business. But if you're not with the right people, you are so much better off being in the public markets right now. And so, yes, JC, that's why I continue to talk about the public markets more than the venture market.
I'm fascinated by the fact that the two of you, two guys who I trust and respect, think that the disconnect can continue and persist. I'm pretty fascinated. I find that really interesting.
Here's why, JC, because in the private market, in the private markets, price does not move as fast as in the public market. The VIX just went from 10 to 60. If that doesn't make you reprice things, okay, there's no VIX in the private.
By the way,
market.
we can continue with this. Technology was up last week.
Yeah,
communications were up last week.
And I can tell you that private late stage growth technology took another tick down en masse because everybody would rather be in public markets right now.
Well, Howard, you've been talking about this forever. How many people in the private markets set the prices in the early stage? I don't know, it's one or two dummies that are setting the prices. And in the era...
No, you're wrong. Here's what happened, and this goes to Paul Graham and Y Combinator. Okay, and again, these are just, me and Mike can riff on this forever, but you don't have enough data. But the everybody became a disciple of certain people pricing things. What is Y Combinator doing? Y Combinator is the vanguard of startups. Here's a blanket price for every company this quarter. And guess what? Who reads all that stuff? Every founder in the country. So they think their company is worth that. Okay. This goes to every industry. Not every snowflake is different, right? Every startup is different. Domain experience, where you are in the business. Where's your tech team at? What's your moat? How much capital is it going to take to get the company started? These are like serious questions that need to be asked. That for 6-7 years, we were doing that over Zoom without even asking the questions. So of course things are broken. Like the public markets are hundreds of years old or over 100 years old. The venture market is 30, 40 years old, and the seed stage market is 10 years old. So you had this false signal that's still, so I really am bullish on the public markets because I feel like I have a way better edge if I'm going to spend the next 10 years investing, talking to my friends who have public market experience, than all the people that have learned poorly and picked bad mentors and are basing their decisions on the era of inflated prices and ZERP and low cost of customer acquisition because Apple, Facebook, Meta, TikTok price their inventory low. So your cost of customer acquisition is going to be you're never going to get the cost of customer acquisition prices like you got them in 2010 to 2020. That era is gone. And if you take out that metric alone, probably seed stage startups are still overvalued when they come out for the first round of money by a magnitude of 50 to 75%. No one wants to listen to me. Don't get me wrong. That's okay. But that's what we see. And that's why, Trends with Friends is so important. We're trying to find other places that money is flowing that makes actual sense.
Howard, you think the area of valuation that you like to get involved, do you think that's coming back?
I hope. We're having better conversations. So for 2-3 years, we would just, okay, Howard, goodbye. Right. Not they were mad at us. They would just go get money from someone else. And you and I used to have these conversations. I go, don't do that, right? Like, don't be that guy. And there was always that guy that wanted to be in the game. And there was, and that's over. And as I tell founders who tell me I'm nuts, I said, that's okay. Go take the higher price. But I'm wary of the investor that would give you that price. So you're probably taking the wrong investor, right? Because that investor is playing the wrong game.
Well, and so the other thing that these people are learning now is that when they run out of money, and they do, and they will, you're done. If you raise it to a high valuation, there's no more money.
And momentum is a very precious thing, as we all know. Okay, so if you're going to run a company, you want to maximize your momentum at the highest point of liquidity. It's called escape velocity. And so if you set too much pressure at your company early, and risk momentum early, that's got to be your CEO. I blame that completely on the CEO. VCs are terrible at doing this too because they're young and inexperienced. But a CEO's job is not to run out of money. It's like, what's your job in real estate? Location,
Survive.
location. Your job is to be in a business is stay alive for when the curve hits, right? So when the tide's working with you. And so if the tide's working with you and you risk everything because you're greed about setting the initial price, it's going to come back to haunt you. We've seen it in Robinhood. You can price everything to perfection until a certain point. But once you break momentum, and we see this happen with public companies all the time, with Starbucks, just maybe they reverse momentum by bringing in a new CEO. Look at the years you can spend in the forest, in the desert, wandering sideways, trying to rebuild momentum. And so we have to teach early stage founders that momentum, even though it shouldn't be a word in early stage starting, is a precious commodity. And you should protect your momentum and underprice things so you give yourself optionality. Okay, next, we should talk about a few trends, Phil.
Also, just really quickly, from a behavioral point of view, structurally, you don't have this ability to get these short-term washouts like we got last week because you don't have the liquidity, you don't have the news cycle and constant focus, you don't have the retail investor and other investors who are able to just freak out and sell. And so you get this long cycle where things get completely out of hand and nobody's noticing, and you don't have this underlying sentiment kind of a put. You remember they used to use that term Greenspan put. You don't have that put underneath the market in this in the venture market. I think that's a component as well. Why these cycles play out so long.
And I'll tell you what sucks about our job right now. The high intentionally want to help seed stage investors. We're having conversations that have nothing to do with the company or product. We're having conversations about education, about cap table, and how to optimize surviving. Like, shouldn't you know that? So there's been so much bad education from like Y Combinator and the people that everybody held on a pedestal, right? Because of momentum, right? They literally believed their own bullshit because free money. And now they have podcasts, and they're very popular podcasts. And now they're telling you how to pick presidents, and they're telling it's a Jim Cramer 2.0 phenomenon, and it's not something I predicted. Okay,
that's ahead, a healthy sign. Okay, let's talk about an industry that JC has been all over. That's making all-time highs. The exchanges. He's got like 3 or 4 of them. They're killing it. And I know, Howard, you have a take on it as well. But JC, why don't you just walk us through a few of these beautiful looking.
How could you be bearish with charts like this?
Right. It's a capital markets thing. You're seeing it in the exchanges for sure, but it's capital markets in general. We already talked about like Raymond James and LPL and Jefferies and all of these things that have been doing great. Look at the Intercontinental Exchange. This owns the New York Stock Exchange, $88 billion. Look at the NASDAQ, not the Qs, but the actual company, the NASDAQ.
You have that chart?
Yeah, $39 billion there for the NASDAQ. Go up.
I got to buy this stock. I keep looking at it. I got to buy this.
You don't have to buy it yet, but you're going to have a good... listen, I own ICE, I own CBOE, I own CMA. I was on the show talking about it. They're in my degenerate
And NASDAQ's actually the worst
ETF.
one.
Right. NASDAQ's the worst one because it's the worst management. Because I know NASDAQ. I deal with their salespeople. They have a bad mission from the top. For decades, sell the data. NASDAQ could have been their own venture fund. If you want to look at where NASDAQ failed, whoever's running this company in 2021 beyond has done a shit job, okay? Because they're selling stuff for $10,000 a month to startups that they could have got 2% equity in. So they have been chasing their quarterly numbers and leaving the industry and selling their own future
data. We get our options data for our app comes from the NASDAQ. I love it.
Okay.
It sounds like the next
such
Starbucks.
Bad leadership. Yeah, this company is going to figure it out because their data. The other thing these exchanges have going for them, they have their own data. They own this data. So in the world of AI and LLMs, and ability to like stop people from scraping the data. Standard.
But look, it's all of them. It's CBOE, ICE. Look at
I'll add
S&P.
NASDAQ. I'll add, and we talked about Goldman in the high 300s, but they are the worst run of these businesses because they're still running this business like it was 30 years ago. And when you talk to a startup in fintech, they can't pay 20 grand a month for your fucking data. So what you're supposed to do is take 5 to 10% of their equity, be the Y Combinator of exchanges. That was what Y Combinator got right. Take equity. Don't get paid for something that's going to be worth 100 times more in 10 years. But because NASDAQ's running to a quarterly number, this is the danger of being a public company. They fucking shit on their shareholders and because they're not thinking. But not so with the CBOE, ICE, and CME. And NASDAQ eventually will break out because a bunch of hedge funds will say, fuck, like, why? They won't look at the work. They'll just look at the chart and go, oh, it's a breakout. But yeah, I would think, Mike, it seems inevitable that NASDAQ will break out here, but it's also the dog of the group.
Yeah, look at the other ones. The other ones have all broken out. They're all making new highs. Look at ICE.
No, JC, I'd be curious to hear your take on this. When you see a company or a chart like NASDAQ, forget the company, a chart like NASDAQ, do you say, all right, I'm going to buy this because it's going to catch up? Do you say just stick with the leaders?
It's a great question. We think about it all the time. I like sticking with the leaders because if that NASDAQ is going to work, you don't think ICE and CBOE are working?
Yeah. See, that's where I get wrong. I have this like compulsion to just buy the ones that are like lagging, like, oh, it'll break out.
They're lagging for a reason. Lindzon's giving you reasons, right? He's literally telling you why. There's always a why. In some cases we know, in some cases we don't. What Howard's saying makes sense to me, but you're seeing it in the price itself.
No, I'm not giving you. I'm giving you 5 or 10 data points of why, because I deal with NASDAQ. Right?
Look at Standard & Poor's is the other one. S&P Global.
Goldman Sachs. So keep it simple. Again, these are all part of my degenerate economy ETF.
150 billion, Howard.
These are the Visas and MasterCards with much higher margins of the next generation. In a degenerate economy where people want to have odds on everything, and I'm not judging people. I think you give people a casino in their pocket, they're going to play the game. Don't buy DraftKings. Okay, you buy the people that have high margin businesses that make the markets for this. This will probably be one of the biggest Visa, MasterCard looking bull markets, except that these companies print money. They don't take 1% or 2%. Now, again, I could be wrong, and we'll just trade it along the way. But I'm saying this is too big a trend, and these companies are too good at what they do, and NASDAQ hasn't been good enough at what they do, but that should get dragged up with the rest of them. And believe me, I'd like to tell NASDAQ what to do, and over the years I've had opportunities to tell them, and they just don't get it. They want to meet that quarterly number and sell stock with NASDAQ data for 20 grand a month versus taking a quarter point in warrants and helping us grow our business. And that's what made Y Combinator great. That's what's kept Wall Street behind for 10 years. That's why these companies went sideways for 10 years, Goldman Sachs included. They were trying to play the VC game. They should have just playing the torture and abuse game, which they're very good at and getting back to doing right again. Companies that are doing well don't have to change their business model, but companies that are going sideways sometimes get lucky. AI is going to help these markets because they have so much data that people need. But they also have to change their business. Lastly here, Phil, and I got to hop, gold. Something that doesn't need to ever change is not enough people have yellow fever. JC and I were out 4 months ago, talking about buying gold. I did GLD on the breakout of 183. Gold doesn't need a president. Bitcoin seems to need Trump. Supposedly, if you talk to the venture capitalists, there's no gold venture capitalists on Twitter going, please, I hope Trump wins. You know what gold's rooting for? Both candidates. Gold is the happy. Gold hopes all the candidates should have a lollipop and balloon because they all suck. And so the biggest
Howard, gold is a great example of an asset that cares a little bit about what's happening in the United States, but mostly cares about what's happening in the world, right? So that next chart that's got gold pricing all the currencies, right? Yes. The fact that it's breaking out in the dollar too is inevitable, but this is a global thing, right, Pearls?
And shared this. We were on this.
JC was on this one in April. He showed us this in April. It was a beautiful chart, and it was a global chart. and it was a nice call. It was a nice call, buddy. And now
it's
you have
not
that
just
one.
a nice call.
You have that one that's up to date.
It proves, again, like I said, there's no gold venture capitalist begging for, we need Trump and regulation, right? Gold's bet internationally is being handled by the EU. Maybe the only worse run company in the world other than Twitter is the EU, which continually is gold's best friend. There's every international country is gold's best friend right now, because they don't understand Bitcoin quite yet. And Gold's not complaining about how bad candidates are. They like all bad candidates, right? Gold's benefiting from all the bad candidates. And that's how Bitcoin people should be thinking too. They should be encouraging both people and not worried about which one's going to win.
And regular people have discovered gold. It's sold out at Costco.
Oh, right. Good point. We talked about that. Selling out at Costco. Do you do anything for clients here? If clients ask, Batnick? Okay.
Can you imagine Batnick the gold bug?
Batnick the gold bug, but like they talk about crypto, and gold's in a much better trend and a much smoother trend breaking out here. So it's like, it's just not, no one cares. Those are good trends to be in. I call them trends with no friends.
They're not. It's
no
not.
One cares
It's not in the Journal. It's not on USA Today. You're right. It's very under the radar.
Michael, do you guys don't have gold sleeves for no, right? You don't you don't mess around with it. That's like the antithesis of the Red Hook Wealth Manager.
It's not our ethos.
By the way, gold ETFs, $250 billion versus Bitcoin ETFs about 60 trillion. I looked it up. A billion. So gold is a 16 trillion market around the world, to your point on the global piece of it, but on the ability to buy it and sell it frictionless, ETFs, it's $250 billion. It's still barely started.
It's nowhere near that, Michael. It's nowhere near that. It's not $250 billion. ETFs?
ETFs? Yeah, I looked it up, but we can compare sources. Yeah.
I mean, the GLD is 65 and the GDX is only like 15 or something like that. It's nothing, Michael.
Okay, I looked it up. Okay,
unless there's like global ETFs that I don't know about that all these Indians are piling into, which is
Oh, by the way,
guys, we're going to wrap it up. We're going to wrap it up. We were going to cover Bitcoin and sort of the politics of Bitcoin.
Can I say one thing before we get out of here?
You get the last word.
Before we get out of here, Howard and Phil too. I discovered StockTwits in 2009. You guys helped me get into the game. Phil, you changed my career, so thank you. Howard, thank you for everything over the years. I love you guys. JC, love you too. Michael, nice to meet you.
Michael, same.
All right, we'll end it there. I appreciate it, Mike. It's great to hang out with our friends. Hopefully we share the good ideas. We do like gold. We like trends with no friends. We do love the exchanges here, like we like Goldman before. And we think VC is still in a quagmire. So we've covered a lot. Apple and Google and AI will cover, I think, in a week with NVIDIA's earnings calls. Michael, we'll have you back. Have a good week, everybody.
Adios.